Hello everyone, welcome to Group 5. The members are Adiwa Fida Hariswan, Haryandi, and Novegia Fadini. Today we want to talk about the accuracy and understanding about credit analysis, capital structure, and solvency. There are three materials that we want to talk about. First one is basic of solvency. Second is capital structure, composition, and solvency. Third is earning coverage. The first one is about basic of solvency. Analyzing solvency of a company is markedly different from analyzing liquidity. There are 3 points that I want to talk about. The first one is importance of capital structure. Second one is motivation for debt capital. Third is adjustment for capital structure and analysis. The first one is about importance of capital structure. Capital structure is the equity and debt financing of a company, and it is often measured in terms of the relative magnitude of the various financing sources. A company's financial stability and risk of insolvency depend on its financing source and the types and amount of various assets it owns. And there is also characteristic of debt and equity. The first point is equity refers to the risk capital of the company. Characteristic of equity capital include its uncertain or unspecified return and its lack of any repayment pattern. Second point is unlike equity capital, both short-term and long-term debt capital must be repaid. The longer the debt repayment period and the less demanding its repayment provision, it makes easier for the company to service debt capital. And last point is financial leverage. Financial leverage is the use of debt to increase earning. Leverage magnifies both managerial success or income and failure or loss. Second point is about motivation for debt capital. From a shareholder's perspective, debt is a private external financing source for at least two reasons. First one is interest on most debt is fixed and provided interest cost is less than the return on net operating asset, the excess return is to benefit of equity investor. Second is interest is a tax deductible expense, whereas dividends are not. And also in motivation for debt capital, there is concept of financial leverage. First one is companies with financial leverage are said to be trading on the equity. This indicates the company is using equity capital as a borrowing base in a desire to reap excess returns. Second is tax deductibility of interest. One reason for advantageous position of debt is tax deductibility of the interest. And last, other effect of leverage. A growth company can avoid earning per share dilution through issuance of debt. In addition, if interest rates are increasing, a leveraged company paying a fixed lower interest rate is more profitable than its non-leveraged competitor. And third point is about adjustment for capital structure analysis. Measurement and disclosure of liability or debt and equity account in financial statement are governed by the application of accepted accounting principle. In adjustment for capital structure analysis, there is also adjustment to book values of liabilities. The first one is deferred income tax. An important question is whether we treat deferred tax as a liability, as equity, or as a part debt and part equity. And our answer is depend on the nature of deferral, past experience of the account, and likelihood of future reversal. Second is operating lease. Current accounting practice requires that most financing long-term, non-cancelable lease be shown as a debt. Third is off-balance sheet financing. In determining the debt for a company, our analysis must be aware that some managers attempt to understate debt, often with new and sometimes complex means. Fourth is contingent liabilities. Contingencies, such as product guarantees and warranties, represent obligation to offer future service or goods that are classified as liabilities. Fifth is minority interest. Minority interest in consolidated financial statement represent the book value of ownership interest of minority shareholders of the subsidiaries in the consolidated group. Six is convertible debt. Convertible debt usually report among liabilities, and the last is preferred stock. Most preferred stock requires no obligation for payment of dividends or repayment of principal.
Okay, second is capital structure, composition, and solvency. The fundamental risk with a leveraged capital structure is the risk of inadequate cash under condition of adversity. Debt involves a commitment to pay fixed charge in the form of interest and principal repayments. This section discusses several measures commonly used to estimate the degree of financial leverage and to evaluate the risks of insolvency. Okay, next, common size statement in solvency analysis. A common measure of financial risks for a company is its capital structure composition. Composition analysis is performed by constructing a common size statement of the liabilities and equity section of the balance sheet. We can see the exhibit 10.3 illustrates a common size analysis for Tennessee Teletech Inc. An advantage of a common size analysis of capital structure is revealing the relative magnitude of financing source for a company. We see Tennessee Teletech is primarily financed from common 35.6% and preferred 17.8%, stock liabilities 41.2%, and small amount of earning is retained in the company 4.5%. Common size analysis also lends itself to direct comparison across different companies. A variation of common size analysis is to perform the analysis using ratios. Another variation focuses only on long-term financing source, excluding current liabilities. Okay, next is capital structure measure for solvency analysis. Capital structure ratios are another means of solvency analysis. Ratio measure of capital structure relate components of capital structure to each other or their total. In this section, we describe the most common of these ratios. We must take care to understand the meaning and computation of any measure or ratios before applying it. There are some analysis that we can do related to the equity and debt. The first is total debt to total capital. A comprehensive ratio is available to measure the relation between total debt, that is current debt, long-term debt. Other liabilities are determined by analysis such as deferred taxes and redeemable preferred, and total capital. Total debt, stockholder equity, including preferred. It's computed as total debt divided by total capital. And the second is total debt to equity capital. Another measure of the relation of debt to capital source is the ratio of total debt, as defined above, to equity capital. The total debt to equity capital ratio defined as total debt divided by shareholders' equity. And the third is long-term debt to equity capital. The long-term debt to equity capital ratio measures the relation of long-term debt, usually defined as all non-current liabilities, to equity capital. A ratio in excess of 1 divided 1 per 1 indicate greater long-term debt financing compared to equity capital. This ratio is commonly referred to as the debt to equity ratio, and and it's computed as long-term debt divided by shareholders' equity. And the fourth is short-term debt to total debt. Short-term debt as opposite to long-term debt or sinking fund requirements is an indicator of enterprise reliance on short-term or primarily bank financing. Short-term debt is usually subject to frequent changes in interest rates. And then interpretation of capital structure measure. So after we analyze that what the function of it, common size ratio analysis of capital structure are primarily measure the risk of company's capital structure. The higher the proportion of debt, the larger the fixed charge of interest and debt repayment, and the greater likelihood of insolvency during the periods of earning decline or hardship. Capital structure measure serve as screening devices. For example, when the ratio of debt to equity capital is relatively small, like 10% or less, there is no apparent concern with this aspect of the company's financial condition. Our analysis is probably better directed elsewhere. Solve our analysis revealed debt is a significant part of capitalization, then further analysis is necessary. And then asset composition in solvency analysis. The asset a company employs in its operating activities determine to some extent the source of financing. For example, fixed and other long-term assets are typically not financed with short-term loans. These long-term assets are usually financed with equity capital. Debt capital is also a common source of long-term asset financing, especially in industries like utilities where the revenue sources are stable. Asset composition analysis is an important tool in assessing the risk exposure of companies' capital structure. Asset composition is typically evaluated using common size statement of asset balances.
Okay, the last topic here is about earning coverage. One of the limitations of the size of the capital structure is its inability to see the availability of cash flow to pay off the company's debt. When debt is paid off, the size of the capital structure usually improves, while the annual cash requirement to pay interest or set aside funds does not change or increase. This limitation highlights the important role of the company's profit coverage or the availability to generate profits as source of interest and principal payment. So the formula of cash flow to fixed charge we can use is like earning available to fixed charge divided to fixed charge. And how to calculate cash flow to fixed charge? Here we have several indicators or numbers that we can use to calculate it. We are so sorry because perhaps you cannot see it clearer because it's too small, but you can find it in our books. This is talking about for calculating fixed charge. For the convenience of presentation, two reserves items are not included in the ratio above, but these items need to be included in the ratio if any. First, the loss of the subsidiary with the majority ownership must be taken into account when calculating the profit. Second, investment losses in the subsidiaries with ownership of less than 50% using the equity method do not need to be included in profit, except for the subsidiaries debt guaranteed by the company. Okay, do you wonder about cash flow relationship with fixed charge? Companies must pay fixed charge in cash, while net income includes revenue generating and expense that do not always generate a required cash immediately. This section describes a case-based fixed expense, or that we also call as fixed charge coverage measure, to overcome this limitation. The formula that we can use is like pre-tax operating cash flow plus adjustment of indicator B to G that we have shown you to our previous slide, and divided by fixed charge. And then talking about earnings coverage of preferred dividend ratio, preferred stock analysis often benefits from a measure of the coverage of return on preferred stock dividend. This analysis is similar to an analysis of how profit covers fixed expense or fixed charge related to debt. This calculation must include all expense incurred before preferred stock dividend in fixed expense. Since preferred stock dividends are not tax deductible, they must be paid at after-tax profit. So this ratio is calculated by pre-tax income plus adjustment B to G, and then divided by fixed charge plus preferred dividend divided by 1 minus tax rate. Well, in the measure of profit coverage provides an understanding of the company's ability to meet its fixed expense from current income. There is a high correlation between profit coverage and debt default rate. That is, the higher the coverage, the lower the default rate. And talking about importance of diversity and profit durability for profit coverage, an important factor in evaluating the measure of earning coverage is the behavior of earnings and cash flow over time. The more stable the company's profit pattern, the lower the measure of acceptable profit coverage. Uncertainty can lead to the need for a higher profit coverage ratio. Both earning variability and earning durability are common measures of this uncertainty over time. In determining the level of acceptable profit coverage, it depends on the calculation method used. The calculation of the ratio of profit to coverage or fixed expense can be calculated using profit before discontinued operation, extraordinary item, and the cumulative impact of accounting changes. The expenditures for those three items result in less fluctuating cash flow, as well as removing important components that are part of the company's business activities. Earnings quality is another important factor. Oh, we are so sorry, there is a cut off on the head of our presentation. Actually, this is talking about capital structure risk and return. A company can increase the risk and potential return of shareholders by increasing debt, replacing equity with debt, resulting in more dangerous capital structure, and the existence of a speculative relationship between risk and return. So, that's all our presentation. If you have another question or you have something that in our mind, you can ask it directly in our discussion. So thank you for your attention. Sorry for our mistakes. See you in the discussion. Thank you.